Welcome to the deep dive. We're jumping straight into Uber's Q3 2025 earnings today. The goal: break down the surprising strength and where exactly they're aiming all that cash.
Exactly. This is really about understanding that pivot. Uber's shown it can make money. Now it's about, well, how do they scale those big future bets? And these strong numbers clearly gave them the confidence to, ease off the margin expansion pedal just a bit to fuel that long-term stuff.
Okay, let's get right into the scorecard then, because the growth was frankly pretty stunning. Trips were up 22% year over year. That's the fastest since 2023, apparently. 3.5 billion trips, just incredible volume.
It is, yeah. And that volume, that's what really pushed the top line. Gross bookings of the total value before paying drivers and all that rose 21%, almost $50 billion, $49.74 billion to be exact. And the key thing is, this wasn't about jacking up prices. It was purely more people using the service more often. Revenue beat expectations too, $13.47 billion, up 20%.
Right, but volume's one thing.
Yeah.
Profitability, cash generation, that's where the story gets really interesting, isn't it? Adjusted EBITDA hit a record $2.3 billion. That's up 33% year over year. Just a reminder for everyone, adjusted EBITDA, it's sort of the key metric for these growth companies. Earnings before interest, taxes, depreciation, amortization, the big stuff.
And crucially, that adjusted profit margin hit 4.5% of gross bookings. That's a 40 basis point improvement. Now, 40 basis points might sound small, like 0.4%, but you multiply that tiny improvement by almost $50 billion in bookings. It adds up to huge dollar growth.
And the cash generation
Nothing growth.
just keeps getting stronger. Trailing 12-month free cash flow, so the actual cash the business generated over the last year after all costs, is sitting near $9 billion, $8.7 billion.
That financial strength, that cushion, is precisely why they feel okay making these big long-term investments that might hurt margins a little bit in the short term. And looking ahead to Q4, management sounds incredibly confident. They're projecting gross bookings up to maybe $53.75 billion.
Yeah.
And adjusted EBITDA somewhere between $2.41 and $2.51 billion.
Okay, hold on though. After all the pressure for years about proving profitability, isn't it a bit risky for management to now say they're deliberately slowing down margin growth? The CFO literally said they're very deliberately moderating the pace of our margin expansion. What's the signal there?
That's a really good question. I think it signals maturity, honestly, and confidence. They feel they've proven the profit model works. So now, instead of squeezing every last bit of margin right this second, they're telling the market, look, we'll accept slightly lower margin percentages for a bit, these margin-dilutive investments, to grab these huge multi-year opportunities. They're still committed to growing profit dollars every year, just not at the absolute maximum rate if it means missing out on things like grocery and retail or AVs.
Okay, that makes sense. That balancing act leads us straight into those growth engines then. Let's start with the user base. Monthly active platform consumers, MAPCs, up 17%, 189 million users globally. But what's really interesting is the engagement, right? Each user taking about 4% more trips per month.
Yeah, and if you slice those trips, delivery is really taking off. Delivery gross bookings grew 25%. And sure, restaurant delivery is still the core, but the really strategic move, the big story, is in grocery and retail. GNR.
GNR isn't just a side thing anymore, is it? Gross bookings run rate around $12 billion and growing meaningfully faster than restaurants. That's huge.
It really is. And the insight here is GNR shifts Uber from being just, a late night food thing to something you use for everyday stuff, getting into regular grocery runs, retail pickups. That captures spending that usually goes elsewhere, like Instacart or local stores. Plus, it's smart strategically. It's already making money on a variable basis and is bringing in new users cheaply who then start using food delivery too. They found it boosts platform use by like 27% for existing users.
That logic tracks. Okay, let's switch to mobility. Grew 20% in gross bookings. There's this interesting strategy mentioned, sparse geography mobility expansion. That's basically their push into the suburbs, yeah.
Exactly. Uber figured out growth isn't just about dense cities anymore. Rideshare in these lower density suburban markets actually grew 1.5 times faster than in the big cities. And management thinks they've only captured about 20% of that potential market.
Yeah.
Lots of room to grow there without needing to launch in whole new countries.
And speaking of costs, they got a pretty big win in the U.S., didn't they? California legislation reduced the uninsured motorist coverage minimums for drivers from $1 million down to $60,000?
Yeah, that's a massive deal, not just some minor regulatory tweak. Management expects it to save them hundreds of millions of dollars.
Yeah.
And the deeper point is, those savings probably get reinvested. Either maybe lower fares for us, which boosts demand, or more fuel for AVs or driver pay. It's a big cost advantage in a huge market.
This is where it gets really forward-looking, though. These 6 strategic pillars that are guiding their investments, funded by all this cash. Pillar 1 is about turning a simple trip into a lifetime customer experience.
Right. The focus is getting people to use both mobility and delivery because users on both platforms, they spend 3 times more each year and they stick around 35% better than someone just using one service. The value difference is just, well, huge.
Wait, did I hear that right? Only 20% of eligible users are actually active on both platforms now. So 80% of their massive user base is just sitting there, basically untapped for cross-selling. That seems like a huge low-hanging fruit.
Exactly. It's like a massive internal marketing opportunity. And their main tool for this is Uber One membership. That's grown to 36 million members. And that membership now touches 2/3 of all delivery gross bookings. So it's really embedding itself there, making users less price sensitive too.
Okay, let's talk about the really techie one. Pillar 2, building a hybrid future. This is autonomous vehicles, AVs. Big partnership with NVIDIA announced using their Hyperion platform, scaling up L4 autonomous vehicles, starting with 5,000 from Stellantis.
And L4, just for context, means high automation. The car drives itself under specific conditions, like within certain mapped areas. No human needed in those zones.
And we're already seeing results, apparently. Phoenix, Austin, Atlanta markets with AVs saw trip growth more than double the rest of the U.S. But AVs are expensive and lose money for years. How does this barbell strategy work? Relying on premium rides like Uber Black seems like a heavy lift to fund it all.
It absolutely is a heavy lift, and they're open about it. That's why they call it the barbell.
Yeah.
One end, premium services like Uber Black, makes good margins now. That profit funds the other end, the expensive, risky, long-term AV investment. They're using today's guaranteed high-margin profits to basically buy cheaper, more reliable supply in the future with AVs. It's a very delicate balancing act.
Which makes the next pillar, focusing on their, 9.4 million drivers and couriers, even more important. Pillar 4, expanding the earning base with multiple gigs. What's that about?
This is really interesting. It's kind of an evolution. They're piloting something called Uber AI Solutions. It offers drivers digital tasks they can do during downtime. Things like rating voice clips, reviewing audio, annotating content. Basically, using the driver's spare time and brain power to help train AI models. It turns the platform into more than just transport. It's a platform for work.
Wow, okay. So moving beyond just moving people and food into the actual gig workspace, competing with platforms like Mechanical Turk, almost, and Pillar 5, the merchant ecosystem, that's about locking in businesses.
Exactly. The big news there was the Toast partnership. Toast is huge in restaurant point-of-sale systems. This integration makes it super easy for restaurants using Toast to get on Uber Eats, manage menus, handle orders. Less friction for the restaurant means they're more likely to use Uber Eats.
And finally, Pillar 6 is technology, with a big focus on generative AI.
Yeah, that's being used everywhere. Automating customer support for common issues, optimizing operations, but also for things like personalized recommendations or upsells in the app based on what you've ordered before or where you are. Try to maximize the value of every time someone opens the app.
So summing this up, record performance now, strong cash flow, but management's very clearly investing hard, maybe even sacrificing some near-term margin for a multi-year future. Which brings us to that big change in how they report financials. That signals something, right?
It really does. It's key to understanding how the company sees itself now. Starting Q1 2026, they're shifting guidance away from primarily adjusted EBITDA to adjusted operating income, and they'll start guiding on adjusted EPS too.
Why move away from adjusted EBITDA? That's been the standard for growth tech for so long. What's the real difference for us watching the company?
Well, the CFO basically said, adjusted operating income, or AOI, gives a tougher, more complete view of how the business is actually running, because it includes real costs that adjusted EBITDA leaves out. The biggest one, stock-based compensation, SBC, plus depreciation and non-M&A amortization.
Ah, stock-based comp. That's how they pay a lot of tech employees with stock grants. That's a real expense, even if it's not cashed out the door immediately.
Exactly. Ignoring SBC, which adjusted EBITDA does, kind of hides the true cost of attracting and keeping talent, especially in tech. By moving to AOI, Uber is saying, okay, we're big enough, mature enough now to account for these real costs. It makes their profit numbers more comparable to traditional companies and, well, more honest about the true cost of doing business at their scale.
Okay, so tying it all together for the listener, the big picture seems to be Uber flexing its muscles, record scale, record cash, accelerating growth, but also taking these calculated risks, even if they dim margins short term, to really own future markets like grocery or autonomous driving.
Precisely. They're trying to redefine themselves, not just transport tech, but a whole platform for managing movement and work. They want to capture that lifetime experience from their users, get them using multiple products, keep them loyal.
Which leaves us with maybe a final thought to chew on. With 9.4 million drivers and couriers and this new multiple gigs thing using AI,
Yeah.
how far could that actually go? Could we see Uber drivers becoming these sort of multitasking digital workers, earning money, doing AI tasks in their downtime, truly making Uber a unified platform for all kinds of labor?